It is one of our key monitoring. If you remember the three imbalances, the debt equity. It's very difficult actually to find the right data. I could give you a guess of what was the quantum of debt in 2006-07, and I could give you a good educated guess of what the quantum of debt is today in pan-European wide. Lower. To give you a precise figure, in the same way as we would have, for example, in the UK with the Mumford University study in the Bank of England. I think that's there. I could point to a very good report that the EBA published, with the stress test. And that was the best piece of research into the bank's exposure to debt and commercial real estate. But that was just a one-off. It's a great exercise of transparency, and we love it. But we're monitoring that very closely. We're, in terms of portfolio insurance in this part of the cycle in some markets, one of the key points is about making sure you're preparing for any liquidity needs, making sure you're not being tempted too much with the debt quotas, making sure that level of debt exposure in the market you're investing in is not going above a threshold that you would actually be very much at risk of seeing that capital value drop significantly. The other thing I think we can actually take advantage of is that regulation of banks has actually introduced an opportunity for debt funds. And that's one thing but very, very specifically in very specific markets we're executing on that strategy. That makes sense, but again, we're not in the higher end of the spectrum. We're just in that sweet spot in the middle.
Two sort of things we've seen expressed in the context of debt is that because life companies are now originating more loans, in terms of the sort of too big to fail issue, in some ways, if there was another significant crisis down the line, that too big to fail issue won't just apply to the banks, it will apply to some of the life companies as well, who of course also have a lot of pension-related liabilities which are increased artificially through all these interest rates. And also, to the extent to which we get into a difficult situation, you can't assume, the likelihood is that alternative debt funds will behave culturally differently than banks. So they're going to be much more prone to implement more quickly an enforcement strategy in that situation, which will also potentially introduce an element of additional sort of volatility into the process.
Okay, good. Charles, you want to come in?
I was just going to make the point that between banks and insurance companies, essentially Basel II regulation prevents banks from using, say, property future to mitigate their market risk, because if they do use that tool, they then have to post prohibitively large amounts of regulatory capital against those positions. So it effectively nullifies the benefits of using it. However, conversely, insurers through Solvency II actually benefit, because if they have a, say, 200 million property portfolio in the UK and they sell down that exposure through a futures contract, i.e. protect those capital values, they can demonstrate to the PRA that effectively they've mitigated their market risk for that portfolio. Therefore, they don't have to put up 25% regulatory capital against that 200 million portfolio. They can deploy that capital into something else. And that's a real benefit that the insurers have over the banks in this market with this new regulation. And Solvency II, of course, only came in January the 1st of this year, but we executed a 200 million deal at the end of last year, specifically so that insurer could deploy that capital, 25%, which is a significant amount, into other things, having demonstrated that they protected their property portfolio in the UK over the course of the next year.